Two cheap stocks trading below 15 times earnings. It's been a while since we've discussed some value opportunities in the market. It's mainly been a lot of growth stocks, a lot of quality stocks, you could say, dividend stocks. I haven't been talking about value stocks or just undervalued, really cheap stocks in general. It's been a while. And I have two very exciting stocks with you guys, and I believe they have massive upside potential. The first one is one that I've talked about many times before. The second one is a new stock, and it's actually my favorite. I like it very much. And I think there's a lot of upsides. There's a pretty amazing opportunity in this market that I believe is somewhat priced to perfection and is getting extended, but there's still always opportunities. I'm going to share them with you today, and I really hope you enjoy this video. The first one, which a lot of you are gonna hate, but it's an opportunity. It's not much about the brand, it's the opportunity. And this is Crocs. And Crocs is a funny stock, but I talked about it a lot of times before. Around $75, $80 per share. Now it's sitting around $139. And it's up around 300% over the last 5 years, but it's still flat from 2021, up like 6 or 7%. And the company has changed a lot since then. And Crocs, they do sell a lot of the Crocs, and a lot of people hate them. And the main, concern around the business that I got before is that they don't have any moat because it's very easy to copy. I mean, you could just buy anything that looks like Crocs, but it's not Crocs. So why would people be buying the brand Crocs if there's so many made in China stuff and made in whatever that looks like Crocs that are much cheaper? So there's no competitive advantage and there's no moat. And this has been the case for many years. But Crocs has continued to gain market share. They have continued to grow revenues, not just in the United States, but also in China. China is still growing 70%, 70% revenue growth in China, 22% international. In China, they really love the Crocs stuff. I don't know why, but they love the Crocs brands, the Crocs stuff that they sell. They've been selling sneaker Crocs now and so many different things. It's not just the old sandals alone. So a lot of people like them, especially in Asia, especially in China. They like them very much, and they've been rapidly growing, and they have some kind of a moat, you could say, and just people keep buying them. I mean, they just keep buying them. They like the brand, just like people like Nike. They like Crocs. It's not maybe just the best brand ever, but people love it. I mean, you just have to admit. And funny enough, Crocs has outperformed Nike over the last 5 years, even over the last 10 years. I believe Crocs has outperformed Nike. And if you look at revenue, it was up around 5%, which isn't very high. And the main problem with Crocs is the Hey Dude brand. Hey Dude declined 17.5%. A lot of you might be familiar with the Hey Dude brand, especially last year. They were very popular, bestseller shoes on Amazon. And I believe that was a big mistake that Crocs make, because Crocs did acquire Hey Dude. And they didn't acquire it for cheap. They paid $2.5 billion for Hey Dude. And that's why there was a lot of uncertainty on the stock, because Hey Dude kept declining after Crocs started buying it. They grew a little bit, then they started declining. And there were a lot of fears that, Hey Dude was just a one-off. It got popular based off TikTok or whatever. People were buying them. But it's not a sustainable brand for the long term. It's not like Crocs. People know Crocs. They know them for decades. They keep buying Crocs. The brand is good. It's sustainable. They keep selling them. But Hey Dude, I believe, was mostly a one-off where it just got popular. Sales exploded. Crocs overpaid for Hey Dude, $2.5 billion. And Hey Dude has been declining since. And it still makes up 21% of total revenue. 79% is for Crocs. So that was a major mistake, in my opinion, that Crocs has made in acquiring Hey Dude. You could also see it from their own guidance. The legacy brand Crocs is expected to grow 7 to 9% in 2024. That's amazing. But Hey Dude, it's going to decline 8 to 10%, which puts up the total number around 3 to 5%. They had some inventories, they've been decreasing. So it might be getting better from here. But again, for me personally, I believe they made a mistake. They should not have acquired Hey Dude. And Hey Dude was mostly a one-off. That's not as sustainable as Crocs, and it's not as durable, and it's not going to be here forever. That's just what I believe. But the company has been doing many different things. They did pay down a lot of debt. Now it's $1.5 billion. So they've been taking debt down is pretty good. They also been buying back some stock for cheap, and the stock is cheap. It's trading at 10 times earnings. 10 times earnings for Crocs is cheap with the margin that Crocs has, which is around 18% margin. If we compare it to Nike, just for fun, because Nike is a premium brand and all that stuff, Nike has 2024, Nike has an 11% net income margin. Crocs, which is a trash stock or a trash brand, you could say a lot of people hate it, it has 18% margin. They have higher margins than Nike, a much better growth profile than Nike. Crocs has been growing 6% EPS. They will likely grow 6 to 8% for the next 5 years. Nike has been 0% growth, and it will be 0% for a while. So it has higher margins than Nike, a better growth profile than Nike, yet Nike is trading at, I think, 24 or 25 times earnings, but Crocs is trading at 10 times earnings, almost the same as the EPS. So you're almost buying it at a one peg ratio, pretty close to a one peg ratio, which makes Crocs, to me, an extremely undervalued stock. And I think whenever the whole hey dude stuff stabilizes and they start growing again, in terms of hey dude, and there's less uncertainty, I wouldn't be surprised if Crocs gets back to 14, 15 times. I'm not going to say it's going to take 19, but 14, 15 times earnings is more fair for a company that's growing EPS 7 to 8% with such margins. I think 14 to 15 times is highly achievable. 10 times for the stock is extremely undervalued, and I see a lot of upside from here, and I like it very, very much. And I think it's one of the best value investing opportunities in the stock market at 10 times earnings for a company like Crocs. This is the first one. The second one, which I personally believe is a better long-term investment, long-term hold than Crocs, because it has a lot of tailwinds, is HII, which is Huntington Ingalls Industry. A lot of you might not be familiar with the stock. A lot of you might not have never heard of the stock. And HII was a spin-off from NOC, which I own personally. I bought it much cheaper. I was 420, and now it's sitting much, much higher, and it's been a good investment. But HII, in my opinion, is the best or the most fairly valued defense stock in the stock market. It's barely up 0.5% year to date. HII, the main business of HII is they manufacture a lot of the aircraft carriers that you see, and this has a very wide moat. Not a lot of people can do it, and there's very limited capacity to do that stuff in the United States, and there's massive demands. There's likely massive investment that's coming into the company to build more ships, to upgrade the Navy, to build a lot more aircraft carriers and many different things. But they mainly have, you could say, three business models. The first one is Newport News, and this is where they manufacture a lot of the ships, or mainly you should say a lot of the aircraft carriers and a lot of the submarines that the Navy uses. In Gales, which is 24%, it's a lot of maintenance stuff, but they also manufacture different kind of ships. Then 23%, which is the most exciting one, is Mission Technologies, because Mission Technologies is higher margin revenues. And the main reason why I believe NOC spinned off HII is because shipbuilding is a very low margin industry, like 2-3% kind of margin. It's a very low margin industry. It's capex heavy, it's labor heavy, and it takes 8 to 10 years to build one aircraft carrier. It takes a very long time, and it's very low margin stuff. But this is why HII started reinvesting their cash flow into acquiring mission technology capabilities and mission technology services, a lot of things in software support, and just kind of different things that are much higher margins. That's going to increase the total net income margin, which is now around 6%, from 2.5 to 3%. It's now sitting at 6%. And it's rapidly growing. And the company has a huge backlog. They don't have enough capacity. And there's many more orders coming, in my opinion. And there's not enough capacity. So it's in a very sweet spot on the geopolitical space and what's happening in the United States. And they have 48 billion in total backlog. Now, I have to remind you, the market cap is only 10 billion. So this is almost 5 times the market cap. Revenues are around 11 billion. And backlog is $48 billion, and it's growing, and it will likely grow much more in the future. So if you're worried about a recession or a market crash or something with the economy, the Fed hiking or cutting, you don't have to worry about that stuff. The 48 billion is here, and there's likely much more coming because it's in a lot of demand. and it's needed. So is they gonna have business no matter what happens in the economy or interest rates or whatever. Looking at margins for the shipbuilding business in Gales, it declined 14% due to some labor problems. The other shipbuilding business increased 17%. But Mission Technologies, which is my favorite, this is what's gonna change the margin profile of the company, and it's gonna give the company a multiple expansion. It went up 300%. Revenue for this Mission Technology is up 19%, and this is gonna be amazing for the company. That's gonna change it. This is what you have to be bullish on if you want to invest in the company. And this company, isn't expensive at all. It has a wide moat, it has a backlog, a 5-year backlog almost, and it has a tailwind in terms of a lot of investment that's needed in the Navy to upgrade the Navy so they could stay competitive. And if you have a change in administration, you're gonna have a lot of incentives, a lot of orders coming in, maybe an increase in capacity, which is gonna increase revenues, rapidly for the company. And you're getting all that stuff for around 15 times earnings. So it's not really trading below 15 times. I did cheat a little bit, but it's trading around 15 times earnings, which in my opinion is not expensive at all, especially if you compare it to other defense companies like NOC and LMT. Yes, they might have higher margins, but if you believe in Mission Technologies, NOC, I should say HII's margins are increasing and they will likely get better in the future. And again, on a historical basis, it might look not as cheap as it is, but before that, they didn't have the Mission Technologies. It wasn't as good in terms of margins, and now they have the Mission Technologies, so it's gonna be a game changer for the company in terms of multiple. And in my opinion, something like HII, with all this business, 15 times earnings, and it's growing EPS 14%, 12%, 12%, 10%. They have a lot of backlog visibility. They had a lot of one-time expenses this year and a lot of things that went wrong with labor and a lot of one-time expenses. I did say that. But 12 to 14%, this is again almost one peg ratio, almost one time price to earnings growth, which you don't get very often. And in my opinion, this is at least 14 to 15% a year with something like HII. They have a dividend, they do buybacks from time to time. And I wouldn't be surprised if the company ends up trading 17, 18, closer to 20 times earnings in the long term if Mission Technologies continues to grow and it just gets better from here. So this is my thesis on HII. It's an amazing recession, you could say long-term hold with a lot of tailwinds. It's, I think, one of the best defense stocks to own here on a relative basis to NOC and General Dynamics and LMT. HII is my favorite, and Crocs at 10 times earnings is too cheap to ignore, and I don't think it's gonna stay there for a long time, especially if Hey Dude starts bottoming out and it starts going up, could go 15, 16 times easily. I would not be surprised at all. And that was my 2 ideas for this video for value investments or cheap stocks to buy below 15 times earnings. It wasn't financial advice. I hope you enjoyed this video. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.